Welcome to this week's Market Recap, where we review the key developments that have shaped markets, highlight what drove our recent performance, and look ahead to important events on the horizon. Second quarter GDP growth was revised to 3.8% from the 3.3% estimate. More importantly, consumer spending has been upgraded to 2.5% from just 1.6% previously. This tells us American households remain in solid financial shape despite higher interest rates and ongoing economic uncertainty. What's particularly reassuring is that the inflation measures within this report remain well contained, showing we can maintain strong growth without excessive price pressures. For our portfolios, this creates an ideal environment where companies can expand their businesses while still managing costs effectively. It reinforces our strategy of owning high-quality businesses that are positioned to benefit from continued consumer demand and economic resilience. Treasury bonds performed well this week, with the 10-year yield dropping to 4.13% as investors awaited guidance from Federal Reserve officials. The bond market is pricing in about 43 basis points of additional rate cuts by year-end, though there's healthy debate about whether slowing employment or persistent inflation will drive Fed decisions. But in this comes opportunities. Current yields remain attractive, and there's potential for price gains if economic conditions moderate. We maintain measured bond exposure because doing so provides steady income and valuable insurance against unexpected slowdowns, once again serving as portfolio stabilizers. Microsoft received a significant vote of confidence from Wall Street analysts. Morgan Stanley has reaffirmed it as a top pick, raising their price target to $625, which represents a 19% upside. The increase in price target stems from Microsoft's dominant cloud computing position through Azure, which is expected to capture the largest share of business technology spending increases over the next 3 years. What sets Microsoft apart is its ability to integrate AI capabilities directly into software businesses already used daily, creating tremendous customer value and building sustainable advantages. This analysis supports our conviction in established technology leaders that combine strong cash generation with exposure to transformational trends. Now let's examine what drove our strong performance this week and why we remain confident in our strategic positioning. Apple was our standout performer with a 7.98% gain. This was driven by the building excitement around the upcoming iPhone cycle and AI-powered software features. The market is recognizing Apple isn't just a phone company, but an ecosystem business, where customers increasingly rely on multiple Apple products working seamlessly together. This creates tremendous loyalty and provides Apple with multiple ways to generate revenue from each user. The AI integration enthusiasm shows how Apple leverages its massive user base to introduce new capabilities that customers value and willingly pay for. What's impressive is Apple's ability to maintain premium positioning even as competitors try to match its features. This demonstrates their brand strength and user experience quality that strengthens customer retention. Information technology was our strongest sector contributor. Nearly every tech holding has posted solid gains. Apple led with its 7.98% rise, while NVIDIA, Qualcomm, and ASML also delivered steady returns. Several powerful trends are converging. Businesses are accelerating their AI tool adoption, governments are incentivizing domestic chip production, and established tech leaders are benefiting from stable international trade relationships. Our technology companies possess scale and financial resources that smaller competitors lack, enabling them to navigate complex policy environments while investing heavily in next-generation innovations. Despite higher valuations, growth potential justifies our meaningful allocation in these cash-generating businesses with technological advantages protecting their market positions. Our size strategy delivered strong results, contributing 0.19% as large-cap holdings significantly outperformed smaller companies. Apple led with its 7.98% gain, while Tesla, NVIDIA, and Berkshire Hathaway also contributed positive returns. Even Toronto Dominion Bank participated in this quality large-cap leadership trend. This reflects investor preference shifts during uncertain times toward companies with proven track records and financial strength. Large companies possess advantages smaller companies cannot replicate: global scale for capturing opportunities, deep financial resources for weathering storms, and the ability to invest in cutting-edge growth technologies. While some worry about mega-cap concentration, we see investors rewarding companies earning market leadership through superior execution and competitive positioning. Looking ahead, here are the key events we're monitoring that could shape markets in the coming week. Tuesday, September 30th will bring the Job Openings and Labor Turnover Survey known as JOLTS. It provides valuable insights into labor market dynamics beyond just employment numbers. This report shows how many job openings employers post, how many employees voluntarily quit, and how many were laid off. The quit rate particularly matters as it demonstrates worker confidence. When people feel secure about finding new jobs, they're more likely to willingly leave current positions for better opportunities. Recent JOLTS data showed job openings declining from post-pandemic peaks, suggesting labor markets are cooling. For investors, this most recent data will gauge both consumer confidence and business optimism. High job openings will indicate growing companies needing workers, while elevated quit rates will suggest consumers feel financially secure enough to change jobs. Wednesday, October 1st's ISM Manufacturing Index will offer our first comprehensive look at how American factories performed in September. This Purchasing Managers Survey covers new orders, production levels, employment, and supplier delivery times. Readings above 50 indicate manufacturing expansion, while readings below 50 suggest contraction. What makes this survey particularly valuable is its timeliness. It reflects activity from the immediately preceding month, making it more current than many other indicators. Manufacturing often serves as an early economic indicator despite being smaller than services. Strong factory activity suggests healthy business investment and consumer goods demand. We'll watch for signs that trade policy changes or global conditions affect American manufacturers. Next Friday, October 3rd, will bring the September Jobs Report, which will provide crucial labor market insights. This information will be especially important in the context of the current slowdown in employment growth. This August saw only 22,000 new jobs added, well below normal levels, raising questions about whether this slowdown is a temporary weakness or a more concerning long-term trend. Fed officials have expressed growing employment concerns, making this report particularly significant for policy expectations. We'll be watching headline job numbers plus unemployment rate, labor participation, and wage growth trends. Strong employment would support consumer spending and corporate profits, while moderately softer job markets could benefit markets if they convince the Fed to continue cutting rates without signaling economic distress. As always, we remain focused on what matters most, helping you achieve your long-term financial goals through disciplined investing and thoughtful portfolio management. Thanks for joining us, and we'll see you next week.